All right, greetings, my friends. My name is Weston Nakamura from Blockworks Macro in Tokyo. It's Friday, May 26, 2023 at Asia Markets Close. Welcome to the Market Depth Podcast, bringing you global market commentary and analysis from the Asia Pacific trading session so that you know what happened overnight. It's been another bad month for markets that are tied to China across asset classes, and an especially bad week to end this bad month, as now basically all year-to-date gains are gone across Chinese equities, currencies, commodities related to the China reopen theme, and so on, okay? In other words, all of these various markets that started the year poised for a China economic boom have now finally priced out the reopen in terms of year-to-date and are now potentially pricing in a worsening economic picture out of China. Now, amidst the kind of broader DM equity markets that are rallying to differing degrees as of late, and then the risk focus being kind of squarely focused on the U.S. debt ceiling and, the Fed and inflation and the like, I suspect that much of the economic deterioration in China that's underway and now being reflected in other markets, I think that most of that or much of that may be getting overlooked. So today, I'm just going to simply just show what markets related to China have been doing over the last few weeks, and especially this week, just to catch you up. Okay, let's first look at equities. So year to date, China equity markets have been underperforming the rest of the world, and especially Hong Kong, which has been vastly underperforming and has spent more time in the red than in the green year to date. But this week in particular, the CSI 300 index finally gave up all of its gains on the year and broke into losses on the year. All right. Now, let's take a look at Asia indices year to date. Okay. And you'll see that not only is the CSI 300 now down on the year and the Hang Seng hitting new year-to-date lows, but it's also important to note the contrast with the rest of the Asia region, because it's one thing if the entire region or the world wasn't performing well, as a whole, but it's another thing altogether when China is getting hammered while Japan, Korea, and Taiwan are absolutely surging, right? Asia ex-China is handily outperforming the U.S. China and Hong Kong are not. And as I often say, like measuring month to date or year to date, it's not always very useful of a starting point. It could be just kind of arbitrary. So let's just take a look from specifically November of 2022, which is after the China Party Congress and when the China reopen theme began to, get priced into markets. Okay. So if you measure from that point, those enormous gains that occurred in a very short period of time that started in November of 2022, those are disappearing. And so basically at this point, the reopen theme from its inception of November of 2022 has just given back about half of its upside, right? Because at peak, the Hang Seng was up about 50%, now up 25%. CSI 300 was up 16% at peak, and now it's up 8%. And then this is basically the same thing, but with the yuan, USD, CNH inverted on the chart, and you could see basically the same behavior or price action behavior with the yuan, just giving back most of its reopened gains after peaking. Now, one could look at this chart and say, oh, well, that's not so doom and gloom bad as it seems, right? Because markets haven't erased all of the reopened gains since it kicked off in November. It's still up considerably. Yeah, indeed, that's one way to look at it. Another way to look at it would be, wow, so despite the year-to-date massive underperformance in the equity markets, and in addition to all of the macro data showing a China reopen that's being reversed entirely, almost as if it never even happened, despite all of that, these markets have only priced out half of the anticipated upside and thereby still have much more room to fall to get to quote-unquote fair value. According to those macro fundamentals, i.e., we are not anywhere near back to flat yet. Okay? Either way you want to interpret it, it's up to you. I don't really care. But whichever way it is, I don't necessarily see like a floor in terms of price levels anytime soon, right? Okay, so that's the equity and currency markets. Let's take a look at commodities, namely copper and iron ore. the industrial metals that were expected to boom on higher demand from China. And since that demand never really materialized as expected, commodities are also getting crushed alongside the other Chinese markets. Again, these are happening independently and coincidentally, but stemming from the same source. And again, this was a particularly bad week for copper and for iron ore price action, respectively. Okay, because they both are breaching key downside levels in futures markets. So if you just look at this is LME copper, which was at one point well north of 9,000 in early January. And now, however, it's broken below the key 8,000 level support level on on futures on the London Metal Exchange. Okay, and then for SGX iron ore futures in Singapore, that has also just cracked through a key 100 support level this week. Okay, so it's been a particularly bad week for commodities as well. And then finally, let's just take a look at the fixed income space, where we will once again see more of the same. This is just a chart of China 1-year interest rate swaps, which is basically market pricing for where rates will be, 12 months forward. This has also been falling, and falling very sharply as of late, and also heading towards erasing its gains from that November reopen start, right? So 1-year CNY swaps, those traded as low as just barely above 2% this week. It did hold that level, but, it's far from the highs of, 2.4% or above that it was in March, okay? So there's your sort of cross-asset snapshot of various markets. Equities, currency, commodities, fixed income, all are independently in directional agreement. China's reopen is dead or dying. But either way, it still has potentially more room to fall. All right? So therefore, now all eyes and all pressure is on the PBOC, the central bank. Okay, the PBOC as the economic upside supporter of last resort. So, if you look at Bloomberg's survey of economists, what you'll see is that, first of all, the consensus estimates for China GDP has now been trimmed back to 5.5%. But if you look at this is basically their economists' expectations for China rate cut in their triple R, in their reserve requirement ratio. That's how much cash that banks have to keep on reserve, and so therefore a cut would free up lending. But economists are expecting a 25 basis point cut, but they were previously expecting it to happen in Q4 of this year, and now the consensus has pulled that forward to happen in Q3 of this year. Okay, and it's not just like Bloomberg surveyed economists. It's basically anyone and everyone with their eyes on China who are expecting policy action to come in and save the day. So far, has yet to really come, but nonetheless, that's where basically everybody is. Okay, and until it does come, or while it doesn't come, the natural direction for markets, left unattended, is downward, as we close out yet another week of this sort of price action, right? This is dollar yuan inverted. This is copper futures as well for the week. Okay, now notice this kind of upside move at the end of the week here. All right, now what's that all about? So that's currently underway right now as we speak, and what's happening is we actually do have some bit of policy response, if you want to call it that came out at least in headlines today. And that's what markets are reacting to. That's what that kind of blip up is. All right. So here's the headline: China's state banks seen selling dollars in onshore FX market, according to sources. All right. Now, just for some background, China's state banks often trade on behalf of or via the direction of the PBOC directly in spot FX markets. So this isn't anything like crazy or unusual or whatever, right? Also recall, last Friday when I mentioned that the PBOC put out that very unusual statement warning of FX intervention against what they deemed as sort of speculative one-way flows against the yuan. So this measure would be kind of in line with that public statement that was previously made. Regardless of whether or not the PBOC actually is doing this, right? Like this directing of the big Chinese state banks to sell dollars in the spot market, it almost doesn't even matter as long as that perception is there and therefore becomes a self-fulfilling market reality. But according to this article, citing anonymous sources, State banks had been selling USD to prop up the yuan yesterday and today, Thursday and Friday, okay, of this week. And particularly as the offshore dollar yuan rate was approaching the 7.1 level this morning. And indeed, we saw fairly decisive directional reversal in dollar yuan today, right at that 7.1 level or right near it. And pairing the nearly 1% move lower in yuan over the course of this week. And the more than 2% one-way decline that kicked off earlier this month as dollar yuan broke through into the 7 handle that I had flagged last week as well. Okay, so on the back of this is why we are currently, at the time of this recording, seeing this uptick in reversal in yuan and in copper, and probably in all those other sort of associated markets that are now gaining. Again, independent, but coincidentally moving in line with one another. Now, this little move will likely just be a very sort of short-lived event, as in maybe a 1 or 2 day long thing, probably. But there is a takeaway regarding this and sort of market behavior, okay? This sort of policy hinting and subsequent market response that we see today with these short-lived yuan support signaling, just as we saw, the last Friday, these are microcosms of what may play out in markets at a much bigger scale if and when the PBOC does actually make a material shift to more active easing measures, as in rate cuts, that could come as early as June. So, in other words, if we keep seeing further downside in various markets that are most sensitive to China, that continue to move lower, markets like copper, base metals, of course, Chinese equity markets, the yuan, and all that, right? If those keep heading downwards going forward, and then we get a rate cut by the PBOC in the near term, perhaps in the next month, right? Then we may very well get a very, very sharp reversal rally in these markets. So as much as it might be tempting to short China, be it the currency, the equity market, or even China proxy like copper or even the Aussie dollar, right? To do so now would be very, very risky to do so, in my view. At this point, you've largely missed that trade. And in fact, if you did bet against China from earlier in the year against consensus, at the time, and you did so at higher levels, if you shorted China at higher levels, now actually might be a good time to begin to scale out and exit the trade and lock in your gains, okay? But either way, it's definitely not time to open a new short from here, right? Now, the risk-reward is not in your favor, in my view. But with that said, I think that if one were looking to trade China, and again, this would be highly dependent on both market conditions and economic conditions globally at the time, for which we currently obviously don't know currently. So this commentary is probably going to be of little to zero value currently. But the China trade, if one were so inclined, would be to wait patiently for PBOC stimulus, right? In some form of rate cut or whatever it is, right? And then let markets have a reversal and rally. And then you short into that upside momentum, be it on the yuan, on the index, or even on the U.S. listed, FXI, China ETF, whatever your choice of markets is, right? Because in my view, if such a market response of, an immediate sharp move upwards were to come, it would be short-lived. Because that market activity itself would likely be, it's being driven by short covering, okay? I.e. buying to exit open existing positions and not so much, opening of new longs that are coming in. I don't think that there would be any sort of sudden bull rush back into China at that point because of a PBOC rate cut. Because one, as I pointed out earlier, so much of that is already expected by markets as it is, which is another way of saying that current market conditions that are in downfall that I've just shown you, that's what the markets are doing with an expected rate cut that has yet to come. And so, if and when it comes, that wouldn't be of any surprise, provided that China doesn't go full-out Bank of Japan style, Kuroda style, when massive shock bazooka blasting, which is probably unlikely in the near term, right? But what a policy easing action taken by the PBOC would do is not necessarily, be just a signal of further policy intent, as many are conditioned to think with regards to China monetary stimulus behavior. Like, yes, indeed, it can be a signal of a shift in policy regime from being currently sidelined to now being proactively easing going forward. But only time will tell if that actually comes to fruition. But in the meantime, in the immediate, what a PBOC stimulative policy action taken would do is it would actually signal far more definitively that economic officials at the highest level in China are admitting or are at least confirming that indeed the economy is in such a weak state that it is in need and requires policy support. At the very least, to stem further downside that would continue to deteriorate if left unchecked. Okay? And so just because they cut rates or inject further liquidity or intervene to prop up the currency or to make regulatory changes in whatever manner in order to prop up the economy or markets or whatever, just because they do anything like that, it doesn't mean that it'll actually prop up the actual economy itself, let alone, actually spur growth. And so therefore, a widely expected PBOC stimulus measure in the near term would likely not revive the China reopen sentiment that we had going into this year at anywhere near that level of one-way consensus optimism. So, in my thinking at the moment, that's why I'm saying that the trade might be just to wait out and just wait for the anticipated stimulus to come. And then if and when there's a sharp and short-lived reversal rally on short squeezing, then that may be the window of opportunity to trade against or to trade into, short into, right? And then ride out a resuming of economic and market downside, as markets will then subsequently realize that even the PBOC's powers are not enough, right? So that's just kind of how I'm going about thinking, and approaching China. Now, I also want to flag that there's currently another wave of COVID that's ripping through China. For those who are unaware, this is according to state media, citing a study that was presented by a respiratory disease specialist at like a major biotech conference recently, who's basically saying that this new wave of COVID is coming as immunity from that last wave weakens after the 6-month mark, right? So that would basically be, the last wave being in late 2022 to January of 2023 of this year, 6-month mark being current, right? So this resurgence apparently began about a month ago. Estimates are currently that at the end of May, we'll see 40 million infections per week, and then that's going to peak at 65 million per week at the end of June. End of June is the peak, is what they're saying. Okay, so there's that as well. Look, you could believe the numbers or not, I don't really care. Either way, that's out there, narrative or reality. And so therefore, in either case, it certainly doesn't help this reopen bull case in the immediate term. And if the timing of those sort of projections of peak infections and all that kind of thing, if that's more or less accurate, then that would essentially overlap with the potential June PBOC rate cut window. And therefore, that would further dampen sentiment upon, stimulative measures that are taken. Or maybe it'll make a reopen bull narrative, which would be another opportunity to short into. Either way, my stance is just to watch with patience and not lose the forest for the trees, okay? June will be a very interesting month out of the region, if not for global markets. So make sure that you have your eyes on the region and on market depth. Okay, so that's it for me. On behalf of Blockworks Macro, my name is Weston Nakamura. Thank you for following Market Depth, and we will see you all soon. Thanks.